Stocks to buy near their 52-week low. This is a video that I do every Saturday where I go through a screener and I look at stocks trading near their 52-week low and I talk about them and I give you my analysis on them. And this is just a screener where I look at stocks within 5% of their 52-week low, which are profitable. And you would be surprised the kind of companies that you could find, like Progressive, which is disrupting Geico, and so many other companies you could find. And I look at that every Saturday. I've been doing it for many years. And I'm going to share 3 stocks, highly requested ones, by the way, that are trading at 52-week lows. Some of them could be interesting. And I hope you enjoy it as always. The first one, which is a highly requested stock, maybe by far, is Fiserv. I get asked all the time, why are you skipping Fiserv? Why you don't talk about the stock? I just didn't have time, and I'm going to talk about it now. Fiserv is down 41.5% over the last 6 months. This is a $70 billion company. It's not a small company by any means, and it's down a lot. It's been performing terribly this year, and it could potentially be presenting a buying opportunity. Now, Fiserv, many of you are familiar with the company. They are mainly in merchant solutions, and they have a segment called Clover, which processes payments and does many different things. And Clover is very popular, and it's been growing rapidly in terms of payments and other things. So this is a pretty amazing business model. There's a lot of competition, of course, but the company is still growing volumes 8% and 10%, and they're still doing really well despite the competition that they face. Now, if you look at the company's valuation, for a quick overview, it's trading around 11.8 times earnings. It was trading as high as 22 or 23 times just a few months ago, and now trading at 11.8 times earnings. This is really cheap, taking into consideration that the company is growing earnings per share 16% expected in 2026 and 16% in 2027. So they're growing 16%. You're buying it for 11.8 times earnings. This is less than 1 times PEG ratio, or less than 1 times price to earnings growth. So this is really cheap for Fiserv. But there's a few things with Fiserv, I should say. One of them is, if you look at the price to free cash flow, it's also trading at 11.2 times. But if you look at the enterprise value to free cash flow, it's trading at 16 times. Now, the reason why there's such a big difference is because Fiserv has a lot of debt, and they have $31.5 billion of long-term debt. Their cash position is only $999. So it's around $1 billion in cash and $31 billion in long-term debt. The company has a lot of debt. And again, we take in the enterprise value to free cash flow is at 16 times. 16 times for 15 to 16% earnings per share or free cash flow growth is still, fairly valued, but it's not as cheap as if you bought it just because it's trading at 11 times. So you have to take into consideration the debt. And they do have a lot of debt. Some of it is due to acquisitions. The company does a lot of acquisitions. They just did one not long ago, I believe. So they have a lot of debt, and this debt is costing them around $365 million in interest every single quarter, $365 million. Now, the company is so profitable and so cheap, despite paying $365 million in interest expense, which comes in the income statement before earnings per share. Now, imagine if they can potentially pay off this debt and they can reduce interest expense, their profit would get a major boost. But $365 million every quarter is a big amount on an annualized basis. This is maybe $1.4 billion. So this is a concern, and it's waiting on the stock a little bit. Other than volumes from Clover, which they were a little bit slower for the second half. But it's also the debt, and they have a lot of interest. Now, whenever I see a lot of debt and I see the company paying a lot of interest, I get curious to know the maturities of the debt, meaning if the debt is due in the near term or if it's at a very high interest rate environment, and if they depend on the Fed lowering interest rate. This is very important. Now, if I look at Clover's long-term debt from their latest quarterly report with the SEC filing, for 2025, they have about 721 million in British pound, which is pretty much nothing. In 2026, they have $2 billion due at 3.2% interest. In 2027, and combined, they have about $2 billion due in 1%, 2% interest. This is nothing. In 2028, they have like 1.5, 1.8 at 2.8% interest. So they have $1.5 to $2 billion due every single year, and their maturities are stretched all the way down to 2049. So nothing is going to bankrupt the company anytime soon. They have them well spread out. Most of them are below a 5% interest rate. It's hard to get a better deal. So the company got a very good deal on the debt. And if we compare that to their free cash flow generation, they have $1.5 to $2 billion in debt due every single year. But the company is generating $5.3 billion in free cash flow and is expected to generate $5.8 billion next year and up to $6.3 billion in 2027. This is a free cash flow generating machine, very, very profitable. And again, they can afford to pay down $1.5 to $2 billion every single year, and they're going to have more free cash flow for them to continue the buyback program, which the company has been buying back a lot of stock since 2020, and they've been aggressively reducing their shares outstanding. So I don't see a problem with that. It's, of course, a concern because it's such a large ratio between the cash and the debt, but it's well spread out to 2049, and they have enough, free cash flow power for them to pay down the debt and continue doing buybacks, or if they even want to do dividends or whatever they want to do. So the company is in a very good position. I believe the sell-off is overdone, and I think Fiserv could be presenting a good buying opportunity here. If I'm valuing it on an enterprise value to free cash flow basis, it's trading at 16 times, and free cash flow should grow alongside earnings 15 to 16%. So I see at least a 15 to 16% annual return on a company like Fiserv, but this is excluding a multiple expansion. The company could easily get back to 2022 times once the Clover growth volumes start picking up again in 2026, which they should pick up again. It would be, a very good investment. So I like Fiserv over here. I know many of you own it. I don't see anything major that's wrong other than the debt and some slowdown, but this is normal. If the slowdown in Clover volumes continues in 2026, then it could be a concern. But for now, I really like the company, and it's actually alongside PayPal and Adobe. I would put them in the same category. They're like the hated stocks. They are kind of really presenting the best buying opportunity here as a contrarian bet. And by the way, I'm using Fiscal.AI to come up with all those charts. If you want to try it out, it's give you 2 weeks of free access if you want to use my link down into the description. Now, the second one, which was also a highly requested stock that it's on my watch list. I'm very interested in owning the company. It's been for a while. And this is Intuitive Surgical, which is mainly robotics in the medical space. This is huge. And ticker symbol ISRG. The stock is down 16% year to date. This is one of the best, again, performing stocks ever. It hardly goes down 15, 16% and it stays there. But this time could potentially be different. And I'm going to tell you why. Now, ISRG owns the Da Vinci kind of robot, and they have a certain, a specific package of robots that they do surgeries and they help doctors with precision surgeries and other kind of things. Highly sophisticated equipment. There's over 6,000 Da Vinci installed base in the United States, 2,000 in Europe, 1,800 in Asia, and 541 in the rest of the world, with total of 10,488 Da Vinci systems. Now, the best part is whenever they install those systems, they require certain software upgrades, they require certain maintenance, certain upkeep, and this is critical. They cannot go cheap on that stuff because this is medical. You're messing with people's health. You can't go cheap on that. So they have to hire ISRG to do the maintenance and do the software upgrades and do all these kind of things, which is why 84% of the company's revenues is recurring. I mean, you would not have expected that. You would expect that the company is a hardware company because they're selling all those robots, but it's actually more of a software, or I should say a recurring revenue business model, services, where 84% is from recurring revenue because it costs them $100,000 to $225,000 per year for just services and maintenance. This is absolutely, absolutely insane. And again, it's a beautiful business model, and the growth has been exponential. And but if you look at the recent trend, growth has been pulling back. Earnings per share used to grow 37, then it went to 27. This year is 24. Next year is expected to be 14 and 16%. So the growth has meaningfully slowed down. One of it is because of scale. I mean, the company is getting bigger. If it gets bigger, it's going to be hard to keep growing revenues. But there's another reason, which is a big concern, especially outside the United States, is the Chinese robots. Because the Chinese made robots, a lot of people say they're as good as the Da Vinci robots, but they're like 50% cheaper. So that was an article written in Poland that someone sent to me, which says that the Chinese made whatever Edge MP1000 cost between 1.4 to 1.6 million euros. Now, the Da Vinci robot surgery platform, it could cost 4.6 million euros. So if you're a hospital or if you're a professional, 1.6 million versus 4.6 million, this is a huge, huge difference. And especially in the annual maintenance, I'm sure those Chinese companies are not charging $200,000 per year to just maintain and do the robot. So they're facing a lot of competition from China, cheap competition, and a lot of people say they're as good as a Da Vinci product. I'm not sure about that, but this is a major, major problem, and this is one of them. It's just like Tesla in the United States; they're facing competition from cheap Chinese stuff. It's especially outside the US, it's a major, major problem. But for my earnings per share estimates and my upside potential, I put in the current earnings per share of 814, and I put in 15% over the next 5 years, assuming the growth slows down from 20% to 15 and it remains at 15. I think this is fair. The company's PE ratio right now is trading at 51 times. It's trading at 51 times. It was as high as 73 times earnings just a few months ago in January. That's at 51 times. The average is 48 times, and the company could go as low as 41, 40 times earnings. It has happened many times, and it could potentially happen again. Now, if I'm using the mean, or let's say the average of 48 times earnings, no dividends or anything, I'm getting 78% on the upside from here, or around 12.2% per year. I don't know about you, but that doesn't excite me too much. I tend to want to get it double over the next 5 years, or at least 15% a year. If I want to do that, I would have to pay no more than $393 per share for ISRG, which is a negative 11% from here. And I think it could happen. Now, if it goes to 40 times earnings because the growth slows down so much, that would be like the worst case scenario. If it goes to 40 times, then you have to buy it at $327. But if we're taking the average of 48 times, then you could pay up to $393. So for me personally, $393 is really the maximum I would consider paying for ISRG, and especially around $350 is a sweet spot, because then you would be getting some kind of margin of safety. I don't believe the stock will trade under 40 times because of the recurring revenue and the business model and the margins. I highly doubt it. It's possible, but I highly doubt it. So I think close to 350, but especially under 390, ISRG starts getting very, very interesting. That was my update for today. Not financial advice. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.